Hi, everyone, and welcome to Build Your Future, the Property Developers Podcast. Today, I'd like to interview Dean Brown. Dean is the Managing Director of Aurum Finance. Hello, Dean.
Hi, Tom. How you doing?
Yeah, very well. Yourself?
Yeah, no, it's great to be on there. Thank you very much for having me as a guest. It's much
Good.
appreciated.
I wanted to bring you on. I mean, we've known each other for probably a year and a half now, and obviously relatively local to myself as well, being based in Milton Keynes. And I was kind of having a flick through your LinkedIn and kind of seeing some of your experience, obviously being in the field for a heck of a lot of time. So I thought especially our listeners would get a lot of value from hearing some of your insights. Just for context, we have people that have buy-to-let and HMO portfolios. Now they're looking to kind of take that next step, move into new build, kind of small development or commercial conversions. We then have SME developers that are looking to grow and scale their business. And actually, I had a call the other day where we actually have a few people where plots of land have been passed down to them, and now they're kind of sat on them, essentially kind of figuring out what they're going to do with these plots of land next. So yeah, it's kind of great for you to kind of come on. And what I'd like to start is just talk about 2025. Obviously, for some people, it was kind of a great opportunity. I think for developers, it was a bit of a rough ride, and it was kind of great to hear about your experience and what you saw on that side of things. So obviously, being a broker, you're on the coalface of things. As developers, we're always looking for land, always trying to find opportunities. But being a broker, you obviously deal with a lot of developers and you get a lot of insight from what they're saying and their opinions on the market. So it'd be great to hear kind of your perspective of what you found last year surrounding that.
Yeah, I think it's fair to say that after 2024, which was a pretty poor year for most of the world in the property sector, I think 2025 we all hoped would be a marked improvement. Obviously, the government do their best to mess that up. And I think that really the key issue for a lot of property developers was the sales market. So, after going through 2024, the bill costs went up and the interest rates went up, to then be delivering stock into 2025 that there wasn't really a strong sales market for was quite demoralizing for them. And I think really we spent the whole year really of just helping people to extend facilities, maybe refinance where they can, things like that. And unfortunately, some developments weren't in a position to be refinanced. So the good thing was that a lot of banks were patient with our clients, and other property developers, etc., tended to give them extensions and so forth. So as a property brokerage, we didn't do too much in the way of new development, but a long period of time assisting people, advising them, getting them through their current deals so that, hopefully then into 2026, the market will improve slightly and they'll start to sell their stocks and then go again. And we've definitely seen that. I think we started to see that at the back end of 2025. We did a lot of new development in the second half of the year, first half. And a lot of those were people that had actually gone and got planning on sites themselves, or maybe they'd had this piece of land on their radar for a long time, but perhaps it didn't quite work at the price that was being quoted. And landowners started to get a bit more realistic, I think, in the second half of 2025, and deals started to work a bit better. So that was definitely an improvement. And we're already seeing it in 2026. We're getting a lot of inquiries through for development versus the first half of last year. I think developers really have they've got over 2045, and they always have to have a crystal ball, look 18 months into the future, don't they? So a lot of them are feeling like they need to get on with it now, buy the sites, build it out over the next 12 months and deliver it probably into 2027, where we all hope that it's going to be a bit better again.
For sure. That's really positive news then, the fact that kind of Q1, Q2 of 2025, people were not sat on their hands, but they're waiting to see kind of what was going to happen. And then Q3, Q4, as you said there, things were starting to pick up. So the fact that things are now starting to pick up once more, I think that also aligns with what you were saying about the land market in terms of values. Obviously, a landowner usually has very high expectations of their land. However, by them kind of seeing the news and seeing what's happening with kind of sales rates and people struggling for mortgages and affordability issues and everything else, I think that finally is starting to kind of come downstream. Agents are now starting to have a few more honest conversations with landowners as to what their land is actually truly worth. Now allows developers to actually do deals, because sometimes I think agents and landowners have very high expectations, and sometimes it takes 6 months for them to kind of realize, build costs have gone up, which has impacted land values, or biodiversity net gain has impacted land values, planning delays have impacted land values. So it's only by the landowners and agents kind of having their ear to the ground and getting more consistent news from kind of government that they're kind of going, actually, maybe there is a conversation to be had here about improving our offers and our land values.
Yeah, I totally agree. Yeah, it depends on the land agent a lot of the time and just how experienced they are to be able to, give direction and advice to the landowners, which is realistic. I think, the danger is some land agents aren't of that ilk or that experience and perhaps are misadvising the landowners. They sit on the market for 6 months, even a year at the wrong price, or they have some failed sales because people have offered what they thought it was worth and then they can't get the funding for it. And we're certainly seeing a lot more realism. And we're seeing a lot more deals come back to us that perhaps developers were looking at 6 months or even 12 months ago, and maybe the price is a bit different. We're seeing some creative structures, joint ventures with landowners, maybe some deferred payments and things like that. So I think landowners have certainly started to realise that if they want to sell now, then they need to listen to what the market is telling them. And there's no point accepting the highest offer necessarily. It's whether or not that actual developer can, proceed, get the funding that they need to actually perform. And do you want to sell it the first time or the third time of asking? Most people will take the first time.
I think that's a good point. I think people, especially landowners and probably land agents that are a bit more inexperienced, they are very much dictated by the offer. And so if somebody offers, let's say, £100,000 more for a plot of land, then they will go with them. And then it's only 12 months, 18 months down the line where they've kind of been strung along while the developer's waiting to see what's going to happen with the market and everything else, that they then kind of look to then sell it on the second time around, or perhaps going with someone with a bit more, although a lower price, a bit more certainty around it.
Yeah, definitely. I totally agree. A lot of our clients have seen deals go round and round the market and haven't brought it. They've just held firm. Arguably, their offer's probably lower today than it was, 12, 18 months ago, but it's a realistic offer still. And you touched on it, being a developer at the moment is tough. Planning delays, biodiversity net gain has been brought in, Gateway 2 for some of those larger developments. These are all hampering developers being able to get on and do what they actually really want to do, and that is build houses and apartments for the market. And really, it has to filter down to the land price, all of those additional costs. Otherwise, it just is not going to work.
It's interesting that you said about you've been kind of spending the year assisting developers with extending their finance, etc. Because when people think, I'm going to use a broker, they obviously look at it from a perspective of raising finance on the front end. They don't really think about having to potentially raise finance on the back end. So tell us a little bit more about kind of what facilities there are when people are trying to roll on to new finance options once kind of their development finance ends.
Yeah, I mean, there's a multitude of options. Depends what the focus is for the developer. And if they want to continue trying to sell the properties and they don't intend on retaining them, then there's some really competitive development exit products out there. There are quite a lot of bridging lenders and even development lenders that are offering these bridging facilities or marketing loans for, say, 12 months to give them a bit longer to try and sell those properties. I think they all recognise that it's been a slow market, but not necessarily the developer's fault. And I think the reality is that even if they cut the prices by 15, 20, 50,000 per unit, it doesn't necessarily guarantee a sell. Not that it's unrealistic pricing, it's just that there's not enough buyers in the market. So the general consensus from lenders has been patience, and they've been very patient with people. There does come a point where sometimes you are up against it in terms of the interest that's accumulating and decide what they're going to do. And if they are going to continue to sell, then there's some really competitive development exit products and the rates are coming down on those. So that's helpful for developers. And then the other choice is actually, are you going to retain the stock and let it out? Yeah, you might sit on it for 2 to 5 years and arguably the market might be better. You might decide to bring it all to market at once, or you might start to drip feed some of those units to the market over those 2 to 5 years that you've got the mortgage product on it. And that maybe is a bit more of a sensible approach because you're not sitting there with a stagnant development that's costing you a lot of money in interest. You've actually got some income on the rental to offset the costs.
Servicing the debt, yeah.
And it might not even be about making money on the rentals. It's just about saving money on interest that you would have by sitting there trying to sell them. There is this argument, do you lose the new build premium? And I think, that is a debate that, some developers have with us and lenders. And I would argue at the moment, there probably isn't a huge new build premium, not as we've experienced in previous markets. And people are quite happy to buy a second-hand property, particularly as it's still got a 10-year warranty on it, might be 9 years rather than 10 years, but that's not a big issue. And when you come to market it for sale, you can freshen it up, give it a lick of paint, repair, replace, whatever you need to do to make it as new build as possible, and then launch it to market then when it's a better market. So we're doing a lot of refinancing onto longer term products, and I think that a lot of the investment lenders out there, they're reducing the rates as the base rate's going down. They aren't being competitive. They're being quite creative in the structures, in terms of keeping the rate down wherever possible to make sure that the rental coverage is there. It's harder to refinance a whole block of apartments, for example, than do individual mortgages on houses, because if you're refinancing 20 flats in a block, the valuers will value it on a single investment value, which is typically a discount. So although it sounds good, you might get 75% of the value, you're actually getting 75% of a discounted value.
Yeah.
So it's not going
So
to
it's
get you
still
to
a
the same
big
levels.
shortfall to try and.
Yeah. And that's the issue we've had in 2025, arguably, is that some of those deals where people are quite highly leveraged, they maybe taking mezzanine finance or even equity JV funding, they can't refinance for enough to be able to pay everyone off. So those ones are the ones that have stagnated, needed to extend, needed to sell some of the units before they could refinance. We've seen all different structures, but where people can refinance and pay everyone off, put it onto a mortgage. Obviously, that's quite a sensible approach, and we've got several of those deals going through at the moment with some pretty good options. So yeah, it's been good.
No, it's good. That's good to hear that lenders are being very pragmatic in this environment as well. I think that probably brings peace of mind to quite a few kind of investors and developers that are when they're looking at opportunities, are the lenders going to be there seeing it as an opportunity to take that deal from them? But I think if they do that, then everyone ends up losing, right? The developer loses the deal, the lender will lose money in terms of it having to go to auction or what have you. And actually, they're better off working pragmatically together to say, right, the market's not that great now. What can we do to strengthen all parties' positions?
Yeah, and I totally agree. I think there are certain lenders in the market which are maybe a little bit newer to development or something like that, and maybe haven't experienced this kind of issue in the past per se, and maybe they've been used to doing bridging loans or things like that. And, obviously development comes with its own risks, and the developer may do everything correctly, might build it on time, on budget, but if that market is shifted by the time they come to sell it, then, it's not really their fault. And in my opinion, the lenders should continue to support them. But the problem is some of the newer lenders into that space maybe have funding lines from big investment funds and things like that. They need to pay back or, be able to give back within good time. So they're typically the ones that are asking people to refinance, to move it on. Whereas, a lot of the more established development lenders in this space, they've all been very patient with the clients and been able to continue holding that with them. So, yeah, I think there's a tale of two sides to the market. But, that's where we come in. We advise people, help them structure things, look at other options. We've helped people raise money on other assets, whether that be property or even business assets, to be able to put in a shortfall, to be able to pay off the banks and things like that. We've been quite creative in that way as well, which has helped. And it's helped people get out of a sticky situation, to be honest.
Yeah, no, absolutely. It's nice I find that sometimes a broker or a certain professional will kind of say, this is my lane, this is what I do. But actually, sometimes when the market's like this, you actually need more creative outcomes. And actually, I think that's where certain people kind of stand up above the rest, where they can actually come up with different ideas to bring this sort of value to the client. So out of interest, what are kind of the main reasons for you seeing development finance fail or fall through? Kind of other key red flags that you see developers kind of bring to you that you say, no, this won't work for us?
I think when developers come to us with an opportunity, just to take it back a step, we deal with one man, one woman band developers all the way up to larger establishments, small PLCs. So they have different levels of experience, track record and so forth. Maybe they haven't seen these kind of issues if you're more early stage developer. And, we will look at things properly. We'll, kind of pull it apart, sense check before we send out to any lenders. just go and get a set of terms and give them to the client, because if they're not going to carry through and actually get credit approved, it's just not worth doing, in my opinion. So I've always worked with my team to kind of look at it and sense check a deal before we actually send it out. That, when I say sense check, it's looking at things like the bill costs. Do they look relatively realistic? Have they got contingency in the bill? Have they included things like insurances, holding costs, etc.? Because you can always have some of those costs ancillary to the actual construction of the scheme. And have they been realistic about the profit on costs at the outset when they're going into a deal? And there's lots of deals that we will see and they're unrealistic about the finance costs, or they haven't included some of those things. And when we actually start to put that into the appraisal, you're ending up at a sort of 10, 12% profit on costs. We know it's just not worth putting out to lenders, because it's going to make the client look silly as well as ourselves. So we kind of advise clients, this is what the lenders expect. Lenders ideally want to see 20% profit on costs after finance. That's not always easy to hit. We know that. And there is a bit of flexibility around that. But going from 20% to 10, 12% is just too far. And that's really where the clients need to go back into a negotiation with the landowner, because if your GDV is right, your bill costs are right, the only thing that's wrong has to be the land price. And that's where a lot of our clients have gone back to the drawing board, spoken to those vendors. And some vendors have been receptive and they have renegotiated. Others, they've just got that number in their mind now and they think they're going to achieve that. And it takes time for that to wash through. And eventually those vendors often come back to our clients and end up selling for a lower price. But it's that kind of upfront DD that we like to do and work alongside our clients to make sure that it works for everyone. And then I think during the process where I've seen developers fail or have issues, being honest, it's lack of communication with the lenders. I think all lenders understand development is a risky business. If things do deviate, bill costs can go up, issues can be encountered with often cost money or incur delays. It's down really for the client, the developer, to talk to the lender and explain those situations. And I think sometimes developers are maybe a little bit hesitant to do that because it makes it look bad on them, or they're worried that the bank is going to suddenly have a knee-jerk reaction and call it in or something like that. I think in the main, it's just about having that open communication with the lenders and explaining this. But I think you should always go to the lender with the problem, but hopefully some form of solution as well.
Yeah.
And often that might be that they have to put more money into the deal alongside the bank. The bank isn't always going to fund all of the extra costs. You have to be mindful of that. But I think as long as the bank knows and you keep communicating with them, then they'll always be supportive, as far as they can be.
That's good to hear, because as you just said, Dave, you've got a reputation to uphold. So if you start giving lenders bad deals, essentially, then that impacts your own reputation, not only developers as well. And I guess you also have a duty of care. If a developer comes to you and says, we've got this deal, but it's 11% on cost, well, you're going to say, we have a duty of care that if the market shifts or if bill costs go up or whatever, your margins are already so tight that you could get yourself in some serious trouble. So it's nice that you're able to have these conversations with them on the front end, and having the conversations on the front end is a lot easier than having them on the back end, shall we say.
Absolutely, yeah. And I think clients in the main appreciate our approach. And there's some that perhaps, they've spoken to other brokers in the past and they would get a set of terms very quickly and they think, oh, that's really efficient, that's great. But what they don't realise is that those terms may have come through a sourcing system, an online calculator or something like that. And actually the lenders don't know anything about the deal or about the client's track record or anything else, and how actual realistic are those terms. And I think that's where development is very different to bridging and even investment. Development have a lot more moving parts, and there's even more reliance on the developer's track record and experience. And I think that's where, when I started out as a broker 10 years ago, having been a lender before, having done development finance as a lender and so forth, I think the better that a broker presents the deal to the lender, or even the clients present it to the lender, the more credible it is and more likely you are to get the funding. So our team spend a lot of time putting together a 4 or 5 page executive summary about who the client is, what their track record is, where the deal is, what are the schools like around there, what are the transport links like around there, as well as what is the deal like in terms of numbers. And I think by doing that, a lot of lenders give that a lot of credibility and have given us positive feedback, because it's almost like a mini credit paper. So they get all the pertinent information and they can make a more calculated and structured response and actually give you some terms they can really stand behind. So although that process sometimes takes a little bit longer than perhaps some other brokers might give, the reality is our conversion rate on that is very high.
It
So I
pays
think
dividends.
that's always been the best way.
So we've touched a little bit on bridging finance there. So just for people that are listening, could you just touch upon a little bit of the difference between development finance and bridging finance?
Yeah, so bridging finance, we often see it being used as a short-term option. So typically up to about 12-month term. Yeah, a lot of refurbishment projects are done through bridging, and even pretty extensive refurbishment projects can be done through bridging now. There's some really creative and very high leverage bridging products out there at reasonable rates. So a lot of developers may start out as doing a refurb on a property. Maybe it has a big side plot or rear plot that you can maybe separate the title, get some planning on there for an additional house or two. That's a great way to start out as a developer, in my opinion, because you're refurbishing a house which has a really good value already. So lenders are quite confident to lend upon that. Refurbish it, sell it pretty quickly, get the funds back in pretty quickly to keep your finance costs to a minimum. And then you can sometimes get a free piece of land to the side of it that you then get planning on, and you only need to raise the build costs from the development, which puts you in a much better position from the development finance point of view, because it'll be lower leverage, which means lower costs, and more lenders will be keen to lend on it. So I think that's a really great way of using bridging finance. And really with bridging finance, even on extensive refurbishment projects, they release the money in stages, 2 or 3 payments typically. You don't always have a monitoring surveyor to come and check on the work you've done or anything like that. You're kind of left to your own devices, and they may ask for some pictures and things like that just to show it's done, but they're pretty relaxed about it.
Yeah.
Development finance is very different. Development finance often is used for ground up development or larger scale conversion projects, an office building into a number of apartments and things like that. And the reason you have to go on to development finance is because it's going to take you longer to actually do the project, to build it out, and then obviously to sell the units or refinance them at the end. So typically you might need 18 months, 24 months, etc. And because they are larger projects and they need constant drawdowns on a monthly basis to keep the cash flow going and make sure that project goes quite quickly and gets to fruition in good time, then you need development finance. And that incurs, having a monitoring surveyor that's going to come out to site once a month. They're going to review the work that's been done, review your valuation requests that you put in, and then approve the drawdown. And it means that if you're using a contractor or you're doing a build yourself, that month drawdown coming back into you means that you can keep building and do it quite quickly. So development finance has a lot more moving parts to it and takes longer than bridging finance. But the good news for all borrowers, in my opinion, is that, rates are coming down. There's a lot of money in the market for development finance. There's even new lenders coming into market who are very well backed in terms of capital, and they want to lend. The issue is that there's not enough good deals out there, and it's down to the developers to go and negotiate and find the best deals. And then if they can do that and they've got sufficient track record, then there should be a multitude of options. And our job is to go out there and find the best option for the client.
I guess that's a great point, actually, where lenders obviously make money through lending. So when there's a scarcity of deals, it then creates a certain level of competition that these lenders are then interested in investing in. So let's touch upon a few different lenders. For instance, I had a conversation with Homes England the other day, very different type of lender than a family office, for instance. So just for our listeners, tell us a bit more about different lenders and what they do.
Family offices are typically quite flexible. They can basically do whatever they want to do. They can lend on whatever they want to do. They don't typically have a set guideline. Bank finance lender is going to be typically funded by deposits on account. From savings accounts, and they sit on their own capital and then they lend it out to get a return on that. But they have a very structured, set of parameters for the borrowers, in terms of size of deal they want, or even location in the country, type of product that they're going to develop and so forth. You talk about Homes England, obviously a government entity, which has loads of capital, but they are maybe arguably a little bit slower than some of the mainstream development banks. I'm trying to be nice, but
diplomatic.
They're probably are even more careful in terms of structure and slower and methodic than perhaps some of the mainstream development finance lenders that are just as good, if not better, arguably, but they have a more proactive approach to credit. They can get in front of the credit teams much quicker and so forth. Now, Homes England can be great. And being honest with you, they have certain funding where they can provide money towards enabling the site to actually work. So if there's a major issue in terms of drainage or contamination and things like that, they can provide a grant alongside the actual development finance to clean up the site and get it prepared so that it actually is viable. Mainstream development finance lenders don't have those grants available. So that's where Homes England has been really good. But then in terms of the mainstream, I mean, obviously there's a few different options out there. We work with all of them, and certain ones have certain strengths or certain appetites. And then you go to a different level of lenders where they're just as good as development finance lenders in the banks, but maybe they're not sitting on deposits from savers. Maybe they have funding lines and things like that from other investment funds and lenders. And maybe they have a cost of capital which is a bit higher than the mainstream development finance banks. So they have to charge more. And it's either that they charge more for the same level of gearing and maybe get some more junior developers that maybe don't have quite as much experience as the banks would want. Or maybe they lend a bit more than the mainstream banks. There are some lenders that are lending up to 75% of GDV on a first charge basis. And they can be more flexible and lend those sort of levels where the mainstream banks can't. So really, I mean, without using an old phrase, horses for courses, if we've got a developer that is maybe early stages, maybe only done one project, maybe needs a bit higher gearing, you can't go to the mainstream banks. You're going to go to maybe some of those alternative lenders. They have to recognise they're going to pay a bit more for that funding, but it's short-term pain. Once you've got that track record and profile, then you can move into the next level of banking and get some cheaper rates and so forth.
That makes complete sense. I mean, you touched upon track record there, and we spoke a little bit earlier on in the interview about kind of selling the deal and you putting together kind of a 5-page document around the entity that's obviously doing the borrowing, but then actually the deal itself, i.e. the schools, the location, the sales, etc. So how important is the person and how important is the deal itself? And what can the person actually do to strengthen their position in terms of gaining lending, i.e. partnering up with other developers or other contractors that have greater experience than themselves?
I think, proving that you have some experience in property and construction is really important wherever possible. That doesn't always have to be your own projects that you've developed, but it can be, perhaps experience of working for employment for other developers or other contractors. That can help. We can get funding for first-time developers, and we have done on multiple occasions. There are lenders that actually specialise in that. And they do charge more, don't get me wrong, but they will take a view depending on how credible that story is. So where people have got some construction experience, but maybe haven't done a development of their own, you can still get funded for that. But the truth is you need to be able to prove credibility. How are you going to deliver that project? How good are you at presenting the numbers, and being certain about those build costs and things like that. So being really credible in your presentation is quite important. And I think often it's the case that sometimes we'll get a developer come to us that maybe doesn't quite have enough experience. And then what we've done in the past is introduce project managers that can work alongside them and actually work on their behalf to make sure that the contractor performs for them, maybe puts together the JCT contract properly, make sure that the warranties are done correctly alongside the appointment letters. Whereas if you're new to that, you might have never done a collateral warranty, you might have never done a JCT contract, and that's where costs can escalate massively, or there can be big gaps, and that's where inexperience can be very costly. So we have done deals in the past where we've introduced project managers. We've also funded lots of deals where there have been joint ventures. You might have someone that is a really good contractor and someone that is really good in terms of the numbers and the marketing and the planning and finding sites. A lot of the time, contractors, they want to do development, but they don't have the time or the inclination to go and find the sites. If someone comes along who's really good at that and well connected and great at negotiating sites, they could work really well together as a team. And I think between the two of them, when we present them to a lender, that can be quite powerful as well. So it really depends. If you have a gap in your knowledge or you have a gap in your team, then it's about how do you fill that, whether that's you fill it as a JV or you fill it with an outside consultant. I think there's a few different options there.
Makes complete sense. I think even, as you said there, about putting the project manager in just gives that extra layer of protection, doesn't it?
Absolutely. Yeah. I mean, I've funded deals in the past. I can think of one where I funded it for a lady who had done lots of refurbishments, HMOs, etc. She found a great site for 3 new build apartments. She'd never done new build. She was using a third party contractor. And we got her funding, but one of the conditions of the funding was that we introduced a couple of project managers to her, that she appointed one of them to act on her behalf to make sure that everything was done correctly and properly. The build went really well. You know, it was very smooth because that contractor knew that there was no room for maneuver in there. And that they knew that, you know, between that developer and her team, that all the I's were dotted and the T's were crossed to make sure that there'd be no gaps for, maybe some additional costs and things like that. No, I don't want to, do a disservice to contractors who are listening, but obviously, you know what I mean. There are some road contractors that maybe do see the gaps in experience. And
it's like a contract or anything else, right? It's one of those things that you don't need until you do. So it's always worth having that extra layer of protection, be it through a PM or the correct contracts in place, etc. That I completely understand. So for people that are actually, let's just take it back then. So you started the brokerage, and can I tell us a bit more as kind of the challenges that you face in starting that up and scaling that business?
I was a lender for 20 years, and the last 10 years of that was in development finance, AV funding for developers, and investment management, and culminated in setting up development lenders from scratch. I saw quite a lot during my career, including the massive recession in 2008, which was eye-opening for everyone, really, and had to manage a lot of projects through to completion during that period. Became a developer almost, having to appoint PMs, architects, agents, etc. So I learned a huge amount during that period. I was in sort of fast forward it to 2016, January 16. I launched a corporate finance brokerage with a good friend of mine. We'd been lenders together in the past and so forth. So I came to the other side of the fence, and having been a lender before, I think you really understand, what the good brokers bring to the table in terms of their experience, how to put together cases, really understanding the project and the client and be a part of their team. So when I set that brokerage up, I really wanted us to be in that top level of, brokerages where we could advise people and become part of their team to make sure they get funding and get the best funding that they can. I ran that for a couple of years with a good friend of mine, and that was still based in London. And I came to a point where I thought, actually, I want to set up my own business and a bit of work-life balance. I wanted to be closer to home for family and personal reasons after commuting into London every day for 15 years. This was pre-COVID, so obviously work from home wasn't really an option. And I just decided, actually, there weren't many brokerages in Milton Keynes where we are that did the specialist sort of things that I wanted to do, development finance, equity raising for developers, etc., where there's not many brokerages that do that locally or even nationally. So we set up Aurum 8 years ago, very much property focused, and we grew over time. And, during those periods, obviously, when I first set up the brokerage in January 16, I had a great start. I thought this is, really good. And then June 16, you had Brexit, and I think the whole world stopped for a period of time. That was quite eye-opening because pretty much the whole pipeline disappeared, and then came back again a bit of it over the next 8 to 10 weeks. And it was very similar, when we set up Aurum, after a few years of going really well and growing well. Obviously, COVID hit. No one really knew how to treat that, what was going to happen. But we became very busy again quite quickly because property and construction stayed open, as you know.
Yeah.
And we've got long-standing relationships with clients who've used us again and again, which is great. It shows that we must be doing something correctly. But there are challenges. Growth brings some challenges, in terms of growing the team, moving office, et cetera, higher cost base. And you have to kind of manage that. And, we've expanded the offering as well. So as we've grown the team in terms of brokers, those brokers come with other experience, more investment-based experience, so forth. We've then started a business finance team 3 years ago, which has grown massively, and they do all the asset finance, invoice finance, etc., which are all the other sectors outside of property. But what happens on some deals is some clients will come to us for a property deal and we'll help them raise money through other business finance, through their other businesses. So there's a great crossover between the two. And then 18 months ago, we actually launched Aurum Insurance Brokers. So that is a commercial insurance brokerage. So it means that a client can come to us to fund him. We can help them raise money for property deals. We can help them raise money through other assets, etc. And we can sort out all of their insurance and their warranties, their CAR policies, etc., all under one roof, which has been quite powerful. A lot of our existing client base love that because it's one number to call. They trust us anyway because they're doing the finance. So why not use us for the insurance and the warranty?
Yeah, that's great. It's a bit of a no-brainer when you think
easier.
about it, isn't it? It's a turnkey solution. You're then able to cross-pollinate from your businesses across the whole ecosystem to assist them.
Yeah, and also when you run into challenges, insurance is always a pain because on development, as you know, lenders have different requirements. Some want to be joint insured, some want to be noted, some want to be first loss paid. Not all of that's possible. And if the broker doesn't have experience in terms of going to negotiate with insurance companies about how to get that removed or changed, that can be quite a challenge and sometimes can be a bit of a roadblock. We have it here where we get a facility letter come out from a lender and straight away we'll talk to our clients about the conditions in there, about warranties, about the insurance. We could jump on it straight away. Our team are very experienced in property and construction anyway. And often they've gone into bat and actually negotiated with a lender to take some of that out or reduce their requirements. So it's been working really well and hopefully long may that continue.
That's the benefit of having it in-house as well, isn't it? Instead of going to an external party where you then have to call them and email them everything else, you can do it all in-house, which makes it a lot more faster and efficient, right?
Yeah, often. And, I could just walk across to our insurance team and say, look, we need this today. It's been delayed. Let's get it done now. Whereas if you go to an external insurance broker, you're beholden to them doing it at their behest, whether or not they've got time, etc. Whereas our insurance team, no, it's got to be done now because it impacts our finance team. So there's a lot of benefits to that.
So what expensive mistakes have you seen developers make over the last few years when it comes to developments? And we touched a little bit about kind of soft costs and people kind of leaving things out. Perhaps they're not so experienced in certain areas. Are there any expensive mistakes that you've seen take place which have been quite obvious to have avoided if people were a bit more aware of certain elements?
I think, in terms of mistakes, I think construction wise, no one could have really foreseen the massive increase in build costs that came about.
Yeah, sure.
But I think if you build in a decent level of contingency at the outset, that would have helped to defray a lot of those costs. And at the time before they went up, a lot of clients were building in very small, minuscule contingencies because they were trying to make the deal work and pay more for the land. And I think that for me is something that a lot of our clients have learned, that even though banks are willing now to accept less than 10% contingency in the build cost, a lot of them kept it in their appraisal. And when they're presenting numbers to landowners, they're saying, this is what the lender actually wants to see. This is what I have to build in. That's why I can only pay X for the land. And that does work. So I think they've learned the mistake there potentially that, you need to build in a bit more of a buffer, particularly on conversion schemes, where I've seen major issues has been conversions, large-scale barn conversion schemes, listed buildings and so forth. And I think people have had to, really try and make sure they've got a really good build cost in there. I think the other issue we've seen people in the past get burnt by is utilities connections. Often a developer is very much finger in the air. It's going to cost me 30K to connect on my utilities. There's no real sort of DD into that. How far is the substation? Is there a connection in the road and so forth?
Yeah.
And I think that a lot of our clients have been burned by that, particularly as the cost of the utility companies only seems to have gone up a lot over the past few years. We actually partner with a utilities company who will go and get all the quotes up front. They'll get the DD done, etc. So that when you are appraising the site, that few £100 to do a survey and actually get some real solid costs is so beneficial because it'll save money in the long run. So that's been really helpful. The other one where I think people have made expensive mistakes is not necessarily in the cost, in the quality. And I think lenders have certainly got a bit more choosy about the type of permitted development schemes that they'll fund now.
Hmm.
When PD came out, what was it, 12 years ago now, they pretty much lend on anything. A lot of clients got burnt over recent years because, number one, I think if it's not a quality surrounding in terms of the other buildings, the amenities, the distance from the town centre, etc., I think buyers are a bit more discerning and a bit more picky about that now. And I think also the quality of the products, is it, you can't find many deals now where there's internal bedrooms, stuff like that, which a lot of developers were doing in the past.
Yeah.
Because again, I think where the buy to let market has shrunk because of the rise in interest rates and so forth, developers haven't been bailed out by investors taking those last few units in the scheme. That market hasn't been there. So because it is more owner occupiers buying those units, then they are more choosy. And that's meant it's driven a flight towards quality.
Yeah, interesting. I think that's a good point where developers over the past year have obviously been trying to build and sell. And then with the renters' rights bills and things, we've seen a lot of smaller landlords, 1, 2, 3, 4 units are now saying, you know what, enough's enough with the renters' rights bill. We're going to sell up. So now you kind of got influx of property and opportunities from there. And a lot of young first-time buyers, the ones that my brother's 23, so his friends are constantly having those conversations about when they'll be able to buy their first home and how that will look. And a lot of them are looking for kind of do-uppers that they'll buy, live in, and then they'll kind of do it up over the next 5-6 years, because that is the only way that, or one of the most effective ways that they're seeing they can get on the property market. So it makes sense that a lot of the buy-to-let investors are kind of stepping away from buying kind of those new builds and being able to assist developers with those sorts of exits. But in terms of utilities, just following on from that, I found it the same when I was working for the major house builders. Obviously, the technical team, one of the first things that we would be doing when doing designing layouts, etc., would be, well, where are the utilities? How are we going to pull them through? But then for SMEs, because there are costs associated to everything, sometimes people will try and cut costs and say, oh, we'll figure that out later down the line. And I've seen it firsthand where it gets to later down the line, and then lo and behold, they find out that it's going to cost 100 grand for a certain connection because they hadn't planned for it in the foreground. Again, it's kind of these hidden costs that, if people haven't planned for, can be quite scary at a later time.
Yeah. And we don't want to put developers off, because it is a very good business to be in. There are a lot of pitfalls that you have to be aware of. And ultimately, with any development finance, the lender does ask for a personal guarantee. Your name is on the door and you've got to stand behind those costs. So the more certain you can be about those costs and making sure that you're not having to put further money into the project later down the line, the better it is for you. So, I would say, not necessarily lessons learned, but do your DD up front. Make sure you really delve into the GDV, really delve into comparables, and make sure that if your site is slightly negative versus others, that is priced into those sales figures, and make sure that you've got your build costs as certain as they can be.
Yeah, absolutely. I think just following on from that, I think property development is a great sector. I was reading the Knight Frank report where they're saying they need 4.5 million homes. Obviously, Labour are saying 1.5. And they're not going to get anywhere near to building that many over the next 5 years. They're already I was reading a report that they're already set to be miss the target by about 45%. So the amount of units that we're developing out is reducing. Our population is continuing to increase. I think it's increased by an extra 3 million people over the last couple of years. And so property is very clearly not standing in line with that. And when you look at simple macroeconomics, if there's huge demand and an undersupply, there's always going to be big opportunities. And although there are difficulties we're facing in the market right now, be it bill costs and affordability issues and everything else, actually long term, there's always going to be huge opportunities within the property market. So that kind of nicely drives us on to my next question, which was going to be about, for SME developers when they are looking kind of to the next 3 to 5 years, what's your kind of views and opinions on the market, and what would you kind of advise?
That's an interesting one, because I think it depends who you talk to and where they are in the country or their long-term aspirations. They all have different opinions about that. But my personal opinion is that development is a great sector to be in, providing you've got your numbers correct and you've got a good team around you, then you can make a great success out of it. But I think a lot of our clients are starting to look at, what is the plan B? If plan A typically is the sales of those units, then you have to be mindful that that is a gamble and you never know where that market's going to be in the current climate. And a lot of our clients are starting to look at maybe, if you can't sell those units, what is the next option? Can you rent them out? Can you look at maybe longer term leases to supported living providers, registered providers for social housing, things like that? Because if you're building £1 million houses, that's not necessarily an option. But if you're building 20 houses which are 300,000 each, that's more viable in terms of, converting it to a rental product if that, doesn't come to fruition in terms of sales. So I think a lot of our clients are very keen to do development. They are building in bigger buffers in terms of the margin, and they're making sure that it's viable from the outset. And as long as they do that, I don't think it really matters where you are developing in the country. We've done deals in Scotland all the way down to the south coast, lots of different product types. Some is very high end, some is what I would call first time buyer kind of sector. I think a lot of our clients are also looking at commercial also than ever, because commercial in terms of the opportunities, the longer leases rather than short ASTs and so forth, a lot of them are seeing it as a more viable option. And I think there's a lot of people now using their own pension pots. It's been happening for a few years anyway, but SAS and SIP pensions, being able to utilise your own savings as equity towards deals or to own commercial property is now seen as quite a viable option compared to putting 500 quid a month into Viva and not knowing where that money's going. I think a lot of developers and investors are looking at commercial as a real opportunity now because the yields have moved out and you can get some very good deals. There's a lot of secondary commercial which you can redevelop, maybe even convert the uppers and the rear into apartments as well for sale or long-term letting. There's lots of options in that space as well. So we're seeing a lot of people go towards that kind of stock.
That's a good point, and that's what I wanted to kind of touch upon next. When it comes to residential new build developments, obviously there's the technical analysis there when they're looking at doing the deal. You've then got the planning, if it has planning permission in place, or if it's under option, then they'll obviously have the density plans and everything else drawn up. While a commercial conversion, is financing that more difficult because there's kind of a greater risk in a sense that with new build, what's in the ground, if piling's required, etc. But on a commercial conversion, if you kind of take it back to brick, you're not too sure what you might uncover.
I think it's not necessarily harder. I think it's more about how strong is the developer's track record in that space of converting properties in the past, and also what kind of DD have they done. You can't take a whole building back to brick, that's for sure, but you can do structural surveys. You can, do all sorts of things in terms of the foundations and loadings and things like that to make sure it all stacks up. Ultimately, if the design is good, then you know what it's going to cost to build. I mean, in the past, go back to PD, for example, architects just designed, cutting up the space into a certain number of apartments without too much thought process sometimes about where to go. Does it all align, or is it a real mishmash of design just to make you squeeze as many units into the building as possible? And I think certainly architects are much, much better at that now than they were perhaps 12 years ago when it started. And I think that's been driven by the fact that lenders have been a bit more careful about that and more demanding on the developer to have experience in that space and know what they're doing. But, ultimately, it's not always down to the developer. It's also about the contractor. If they're using a third-party contractor, it needs to be a solid contractor that's done lots of conversion projects in the past, knows what they're doing and so forth. And how good is their quote to the actual developer? Is it just a finger in the air, pounds per square foot, which no lender's going to accept now? Or is it actually properly broken down as a construction contract sum analysis? Does it go into the detail? How much contingencies in there and so forth? And I think as long as you have all of that built into your appraisal, then it's no harder to fund that necessarily than it is a new build scheme.
Yeah, no, I completely agree. Well, thanks for coming on, Dean. I found that really insightful. If people wanted to reach out to you or the team around kind of financing or insurance or anything else, what would be the best way to get in contact?
Look, each business has got its own website. So aurumfinance.co.uk or auriminsurance.co.uk. You can always call the office, reach out to us on LinkedIn as well. There's several members of the team that are all on there, very happy to help. And I would say, just having an upfront conversation, we're more than happy to do. It doesn't mean that you have a deal ready to go before you call us. If you just want an opinion on something, if you just want to run an appraisal by us, you just want to talk about potential risks or options for funding in the market and just how much equity you might need, it is open and very happy to help.
Great. And I'll link your website details into the show notes as well.
And I appreciate you having me on, Tom. And yeah, as I say, you've got a great group there that's growing nicely. I'm certainly going to hopefully come along to some of your events and stuff in the future and hopefully meet with some of the guys that are listening to this as well.
Definitely. I think the developers go-karting event, you and the team definitely got to put a team forward for sure.
Yeah. Well, I am quite competitive in that space, so I'd love to have a go.
Yeah, well, Dean, thanks for coming on.
Thanks, Tom. Appreciate your time.